the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Hey everybody, and welcome back to the podcast, episode 88 today. We are going to dive headfirst into, should I use my savings to pay off or maybe pay down my mortgage or your mortgage, unless you're feeling really, really generous and you could pay mine. But in that case, let's stop wasting time and let's jump into it after we hear from our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
Alrighty, everybody, you've heard the intro, and the offer still stands. If you're feeling really generous, we have plenty of mortgages that I'm sure you could pay off if you really feel like it. But let's assume you're considering paying off or paying down your own mortgage with your savings, your hard-earned savings. We are going to answer that question for you. So think of it as almost the Shakespeare quote, right? Of, what is it, to be or not to be? That is the question. Well, the question today is, how do you use your savings, obviously, for your mortgage? So the best guy we could bring to the table is the bald, brawny, and beautiful Mr. Pacuro. How's it going, man?
Oh, I am great, John. How are you doing?
Hey, pretty good, man. Pretty good. This one, I'm excited about this one as always. I know I say that a ton. It's kind of me on repeat as always. But this is a really good topic because, right, some people think that, you know, we won't say all debt is bad debt, but they look at a mortgage as being a huge, you know, liability. It's a monthly bill that they really don't want to pay. But ironically enough, though, right, somebody might have we'll call it an $800 mortgage, but then they go and buy a car that they're paying more than $800 for, and they're comfortable with that. So I look forward to this one, diving into it. You know, the financial benefits, tax benefits. I know we're going to digest this and dissect this a little bit, but honestly, I don't even know the best place to start with this topic. So I'm going to kind of throw it over to you for that one.
Well, it's a great topic, and apologize for my voice being shot. Attended 5 days straight worth of travel baseball World Series play for our youngest. So, but feeling good. John, I was back down in Panama City Beach, Florida, the birthplace of this here podcast. Some memories.
That's right.
Spewed out.
That's right. Every time I eat pizza, you know, I think about it. You know what's funny too? Thinking of that podcast, it's almost like the smell of pizza reminds me of our first podcast. Probably because we were literally nose to mic, all huddled up on a couch on the little cheesy little $10 lavalier mic that hooked up to an iPhone and a pizza box. But
it's a good thing that we had mouthwash and toothpaste on that trip.
and we're lucky that we like each other. We could, you know, cuddle up on the couch. So
Exactly. Well, I don't know. I can't even segue cuddling into this.
Right.
Into this. So let's coddle our finances here. But this is a great topic. I kind of feel silly that it took us almost 2 years into this podcast, episode 88, to address it. And I can't even take credit for the topic. Someone in our Defeating Taxes private Facebook group proposed this topic and threw it out there for us. And I thought, man, that's a great topic. We had a little bit of content on it that people enjoyed. So yeah, we're in an interesting environment. Interest rates have climbed quite a bit over the last couple years. And there's people that have, through various resources of work and whatever, have stockpiled some assets, some cash. When we say cash, we're not talking not necessarily physical dollar bills cash, although it could be. We're talking about money that's real liquid, okay? So liquid means you can access it quickly. So this would be money in your checking account, your money market account, your savings account at your typical credit union or bank or brokerage account. So, you know, we had this question posed that, hey, if I've got a mortgage, let's say, John, let's just say you have a mortgage with a balance of $200,000 and you've got $250,000 sitting in your bank account, and you could basically take 200,000 of that and wipe out your mortgage should you do it? And when really it comes down to it is we've got different factors, right? There are financial considerations, and then there are tax considerations. And then there are X factors, I'm going to call them, because we like X factors. We use that X factor when we talk about how to pick a tax professional. But yeah, so we've got financial considerations and tax considerations. Let's talk first on the financial considerations, because the first thing you have to figure is this. It's real simple. Take the tax part out of it. What rate of return are you getting on that savings versus what is your mortgage interest rate? So luckily, many people that listen to the show know that my wife and I relocated from Michigan to Franklin, Tennessee about 8 years ago. A couple years after we relocated, we refinanced our home. Luckily, interest rates were at 3% at that point. So our interest rate is super low on our property and our main residence, and our primary residence, I should say. So if I'm getting paid 5-6% from the bank, credit union, etc., does it make sense to take money out of that account that I'm earning 5-6% to pay down or pay off a mortgage that I'm only paying 3% interest on? So you've got to really think about the first financial consideration is think about the interest rate, right? What are you earning versus what are you paying?
And honestly, Chris, I think it's, I know a bunch of lenders and real estate agents. So this is me poking fun at them if they ever happen to listen to this. But I think it's kind of interesting that some of them, I wouldn't call it part of their pitch, right? But when you look at an amortization schedule, sometimes they look at it as, well, this is what you can afford. And obviously, I can't say I know any of them that are too salesy or unethical or anything like that, where they're trying to get you into something you can't afford. But they're always like, hey, if you make double payments, triple payments, you can pay it off so much quicker. So I think us, and my Canadian family always laughs at me because they look at mortgages and credit card debt and everything completely different, which is very interesting. When we get together for the holidays, I think it's great. But I think we're ingrained, to when you own a home, the best thing you can do is own your home outright. But a lot of people, maybe strive to that a little too far. And like you said, they almost overlook, opportunity costs and some of these other things I know we're going to get into. And I mean, you gave the best example starting there, right? Is even if you have a 5 or a 6%, a mortgage, we'll call it 5.5. So even if you're at 5.5, your average checking account now, you're probably getting right around there or a little bit more. I've seen some of them that are 6.5 and up from there. So you're right. I mean, you're basically making a 1.5. I mean, you're almost getting paid a little for not paying off what you have in debt and not even getting into the tax considerations.
Right. So you hit one of the other second of 4 financial considerations is opportunity cost. Opportunity cost is what are the other things that you could do with that cash? So let's take risk out of it, right? Because typically there's a correlation between rate of return and risk. But let's say you have that money sitting in a checking account or a savings account earning 4%. Let's say your interest is 3.5% on your mortgage, but you are interested in a bond, and that bond you feel is safe, and that bond's going to pay you 8%. Well, even though paying the mortgage off might make sense, your opportunity cost is essentially 8% for the bond. So you want to look at what are your other options for that money if you didn't pay your mortgage off. And we say all the time in our practice, no decision is a decision. We say it in life, right? No, sometimes when no decision is a decision. And, I'm sure with you and Stacy, we poke fun. Our wives don't watch this or listen to this. They certainly don't watch it. But, we say, well, hey, what do you want for dinner? I don't know. And you're driving down the road. How about Mexican? Well, I don't care what you want. I don't care. And then you say, well, how about, all right, let's get Mexican food. No, I don't want that. All right, well, let's go grab pizza. Your wife says, no, I don't want it. Wait a sec. So you made a decision that you actually don't want Mexican and you don't want pizza. So your no decision's a decision. So, but the opportunity cost of those funds, is important. Segueing into the third financial consideration is liquidity. I mentioned liquidity in the very beginning, but liquidity means, do I have access to those funds? So let's say to take money and pay down a home equity line of credit, which is typically a higher interest rate right now, and you could always draw on that money if you needed it, most likely. That doesn't hurt your liquidity. But if I've got $100,000 of saved up in my savings and I have a mortgage of $100,000 and I pay it off, if I need $10,000 due to a financial emergency, I can't rip a shingle off my house, right? So you really want to strive for, in my opinion, 3 to 6 months worth of living expenses in your savings account. And then maybe above that, I'd feel comfortable paying down the mortgage. So liquidity is the third financial consideration. And the fourth is really mental. It's having that debt-free mindset. And John, you nailed it. Feeling like I, quote, own my house. And I think that was very, very prevalent with our parents' generation and our grandparents' generation, where they wanted that feeling of maybe they've had bad experiences with banks. Maybe they just, quite frankly, maybe they're mature age and they're worried something's going to happen, or they're going to forget to pay their mortgage for a few months and they're going to, somehow the house is going to get foreclosed and taken from them. So that debt-free peace of mind, if that peace of mind is valuable to you, and you're earning 3% at the bank and you're paying a 3% in interest and you can afford to pay the mortgage off, maybe that peace of mind would be the tipping point. And those are the 4 financial considerations.
Right. And then obviously, I mean, I think maybe 5 or 6 episodes ago, I was just kind of mentally trying to think about it, right? We were talking about interest rates back in the 70s and 80s. They were a lot different. I mean, what was it? Maybe 80s, early 90s, I think that they averaged like 14.5% for your average mortgage or something along those lines. So obviously, if say you're even at 10%, right? It's very hard to find something that you're making 10% interest on year over year and comfortably. So obviously the thoughts were different there. Maybe they looked at it and kind of mentally trained themselves and others, from a financial savings standpoint. You don't want a mortgage if you can avoid it. But then,
yes, go ahead. I'm sorry. Yeah, I mean, you nailed it. In the 1980s, the median mortgage rate was 12.82%. 12.82 is a median, and it ranged from 9.03 to 18.63. That was in the 1980s.
That's a credit card. That's wild.
Yeah, exactly. In the 90s, the median mortgage rate was 7.88. It ranged from about 6.5% to 10 2/3. So we're still in a lower interest rate environment right now.
Right. And then obviously one thing too, I mean, we probably won't go into this today because this is more of a lending question, right? But obviously there's the lendability factor, right? Or you talk about your DTI, your debt to income. Say you have a $3,000 a month mortgage, and all of a sudden you had a life change and you're no longer making $200,000, $300,000, $400,000 a year. Obviously that kind of cuts you off at the knees a little bit as far as for buying an investment, et cetera, et cetera. So obviously there's reasons and planning that goes into that.
Absolutely. And Brenna Carls from the Mortgage Shop does an awesome job talking about DTI, or debt to income ratios. And you nailed it. That's one of my X factors. What are the other non-financial ramifications of paying off your mortgage? We've seen it many times where if a senior citizen wants to, let's say, purchase a home, or wants to, we like to say mature age person, wants to purchase a home or refinance a home, they might have a significant amount of assets, but those assets are in retirement accounts, which they're going to pay tax on to take the money out, and they just don't have a lot of income. They might have Social Security, a small pension. So even though they might have $1.5 million in their IRA, they're struggling to qualify for a $300,000 mortgage. It sounds crazy, but that's true. So X factor would be, how does it affect your credit and your lendability, your debt, debt to service ratios, debt to income, DTI, debt to income ratio. So,
and then we've done 88 episodes of this, and maybe about 30 episodes ago, I think we had somebody on and they brought a new term to the table for us, and that was situationally dependent.
Yes, situationally dependent.
So I think that's very fitting with this one, that depending on what you want to do or what your goals are, planning purpose, etc., it is very situationally dependent.
So let's talk situations, and we talk about the tax considerations when paying off the mortgage or keeping the money in savings. that mortgage interest deduction. So I was talking about, hey, you're earning 3% in your savings account, but you're paying 3% to the bank. What we have to remember is that your mortgage interest is tax deductible if you itemize your deductions. So John, if you're in the to make easy numbers, if you're in the 25% marginal tax rate and you're paying 6% on your mortgage interest, you're really paying 4.5% after tax. So that's something to consider, right? You're out of the 6% you're paying, you're getting a tax benefit. You're getting a tax deduction of the entire amount of interest, but times that by your marginal tax rate. But conversely, excuse me, you're also paying you're paying income tax on the interest income from the savings account. So just because you're getting paid 5%, let's say you're in the 20% marginal tax rate, let's say the bank's paying you 5% on your savings account, you're only keeping 4% if you're in the 20% marginal tax bracket. So 20% of your interest would go to Uncle Sam. We're not even talking about state and local tax. So don't just go apples to apples and what percent's higher should I pay it off. Think about the after tax. That's tax flow. Tax flow and cash flow aren't the same things. We know it's one of our 3 laws. And factor in the mortgage interest deduction and the marginal tax rate on your interest income.
Absolutely. That's a good one too, because I think some people may forget about that too. Just the deduction opportunity with those.
Exactly. And so the second of 3 tax considerations, well, we already went through one of the first 2. One, the mortgage interest deduction and the effect of that tax deduction on how much interest you're paying after tax. 2, federal, state, and local income taxes on any type of income you are receiving, from your bank, credit union, etc., on that interest income, or maybe a dividend if it's a credit union. The final thing on the tax considerations would be this: if that money's in a brokerage account, and let's say you bought Apple stock for $1,000, it's worth $200,000, and you sell the Apple stock and pay down your $200,000 mortgage. What are you not factoring in? You're not factoring in the tax on that $199,000 capital gain. So, yes, we said, should you take money out of your savings? But if you're listening, be aware of, if you're not taking the money out of a savings, checking, or money market account, what are the tax ramifications if you were to sell it at a capital gain, or if that money is in like a pre-tax account, like a 401k or IRA, you might be looking at your statement saying, oh, I've got $200,000 of cash in my IRA. I'm just going to take that cash and pay my mortgage off. Guess what? It's going to be taxable when you take it out of that IRA, traditional IRA or 401k. Now, if it's in a Roth and you can make a qualified distribution, now we don't have to worry about that. So be aware of what type of account the cash or savings is in that you're going to use to pay the mortgage off.
And these are really good too with whatever somebody or whoever somebody's working with, a tax pro, financial planner, etc. Right? Like we'll call it an objective view, but as far as for planning into it, right? Like we'll call them, say you have the taxpayer and the tax pro. So two players on the same team, different positions. You're looking at it from 2 different sides. One, say taxpayer thinks about it as like, wow, I do not want this mortgage. I do not want to be paying for this every month. I just, laser focused. They don't want it. How can I get rid of it? But like we were just talking about, I think we have at least 5 or 6 really, really good points there that almost make you lean on the other side of the fence as far as for, if you're comfortable with it, we'll call it the comfortability factor, then the benefits far outweigh, just getting rid of something, obviously, because, and the great thing is, right, I mean, depending on what kind of mortgage you're in, we'll say 9.999 out of 10 of them, your rate's not going to change. It's fixed. So what it's going to be like in 4, 10, 15 years.
You nailed something too. Mostly the rates are fixed unless you have an adjustable rate mortgage or an ARM. One more thing to consider, you just should have added it in the beginning. Some mortgages, especially on investment properties, might have a prepayment penalty. So you have to factor that in as well. So I could say personally, we paid a prepayment penalty. We sold an investment property once. We did factor that penalty into our profit, and we decided it still was a good idea, but it was definitely a factor to consider when you have a prepayment penalty. So, yep, we have. So here's the situation. Wrapping it up, we have the financial considerations, we have tax considerations, then we have these X factors. It could be the what your long-term plan is. Do you plan to stay at that house forever? Because ultimately, the only way you're going to get your cash back out of that house would be to refinance or sell it. So those are all factors. And what does being debt-free mean to you? Is that important to you? And does that give you peace of mind? In understanding your liquidity and making sure that you have enough in your savings to cover about 3 to 6 months of expenses. And then that would be my final takeaway is, before you consider, depleting any savings, make sure you've got at least 3 months of fixed living expenses in savings before you do that. And always, John, consult a financial advisor, licensed financial advisor, a tax professional, or just go into the Defeating Taxes private Facebook group and say hello.
Absolutely, Chris. Well, thank you so much for diving into this with us. I know at the beginning we said we were going to give away all the answers. I doubt we gave away all the answers because, right, it's so situationally dependent, back to that term. And like you said, too, it really does come down. I mean, I see this from both sides, right? Obviously, we have these conversations. We talk to tons of individuals, tax pros, taxpayers alike, and really just talking with the people on your team and planning for it. This should never be I'm going to do this and I'm going to do this next week, because this is not an oopsie situation. Let me take back and hit the reset button and do something else. Like, once it's done, it's done. I mean, if you're depleting an account and say you don't end up using those funds to pay off a mortgage, well, depending on what it is, you already just triggered for a massive tax bill, depending on when. Then you're just sitting on a bunch of cash, and then you're really up, what creek.
Oh, absolutely. I mean, it could really backfire if let's say you took the money out of a retirement account, you paid off the mortgage, you don't have a mortgage, but you have a tax bill, but now you don't have any cash to pay it. So just build that board of directors. We talk about in Teaching Tax Flow. Build your board of directors. If you don't have one, reach out to John and I personally, and we will make sure we find someone for you to help you.
It's a great way to close it. And as always, as I like to say, maybe to end or not to end, that is the better question, as Shakespeare did not say, nor will he ever say, because he's no longer able to say that. But on that note, we will see everybody back here next week on the Teaching Tax Flow podcast. Different day, similar time, different topic. Tweak that one a little bit. So until next time, everybody, thank you for joining us. Hey everybody, John here from the Teaching Tax Flow team. That's right, we just wrapped up episode 88. Can you believe it? 88 of these shows, you have been listening to us go on and on and on and on. However, I would like to say, I'll toot our horn a little bit, or humble brag, as sometimes we like to say, we've had a ton of listeners. We've hit, if I'm remembering right, 50 or 60 different countries. We're talking tens and tens of thousands of listeners on our shows, which is great. We get great feedback. We're hearing all these topics, people coming up to us at events, emails, messages online saying that they've heard a topic. That's what we love to do. That's what we're here for. And again, 88 weekly episodes we have cranked through. However, here's the ask. Keep the topics coming. Not that we're running out of ideas by any stretch of the imagination, but the whole point of this show is to literally talk on the topics that you guys are interested in. So if you're interested in the topic, just shoot us an email at hello@teachingtaxflow.com. That's hello@teachingtaxflow.com. Shoot us any ideas you have. The worst thing that could happen is, we just forward the email to Chris and he can tell you no. So just kidding. We won't do that. We take some great pride in these. And again, we are here doing these for you. Shoot us those topics. We love them. That's what keeps us going. So we will see everybody, or you should hear us next week here back on the show.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.